Are you an absolute beginner when it comes to investing in property? Maybe you've never invested before and this is now your first investment property that you're looking to get, or maybe you have bought something in the past, but you would still consider yourself a beginner and you now want to know, well, how do you build a property portfolio fast? Well, and if so, this is the episode for you. Hi, my name's Nero. I'm a buyer's agent and the founder of Investment Rise. And today I want to share 5 steps that you need to follow if you want to build a property portfolio fast, especially during these times when interest rates are rising and there's a lot of doom and gloom in the media. So 5 steps to go through. Let's begin with step 1, which is where do you start? Now, let me tell you where I don't think you should start. And it's trying to find the best hotspot to buy, okay? Because too many people will try and sell you on the location, on the infrastructure, on all sorts of things, okay? But that's not where you start, okay? And you definitely don't start with the property. In fact, if anything, if you take nothing away from today, I want you to take away this one message, which is this. When it comes to investing in property, it's not about the property first. It's about the property last. Okay, so you don't start with the location, you don't start with the property. What do you start with? You start with you, right? If you are serious about building a property portfolio, you need to get clear on you. And what in particular do you need to get clear on? Well, number 1, you want to know, what are your goals? What are you trying to do? What are you trying to achieve through investing in property? Okay, so I recently spoke to a new client of ours, and their goal, they're a young family, is not necessarily to build passive income and retire early. They love what they do. They have moved to a regional area and they have the lifestyle that they're after. So they just want to build up a solid portfolio with a few assets so they will have more options in the future, whether it's to help their children out or whatever the case happens to be. Okay, I have other clients who are sort of 10 years before they retire and they don't have enough in super and they really need to get some assets fast so that they can supplement their superannuation when it comes time to retire. Okay, so get clear on what it is you're trying to do when it comes to investing in property, because that will really go a long way to ensuring you buy the right types of property. So get clear on your goals firstly. Secondly, and this might seem pretty obvious, but you want to know what's your borrowing capacity, right? What are you able to afford as from a perspective of how much the bank will lend you? Now, of course, if you've got a significant borrowing capacity, that does not mean that you're going to just max that out on your first property, okay? But you want to know, well, what's your borrowing capacity so that you know how much you can afford, because that'll help you, again, target the right areas and the right type of property. Then number 3, when it comes to getting clear on you, is to get clear on your constraints. All right, now, what do I mean by that? Well, you need to understand, well, and be really honest with yourself here, because only you can get clear on this and answer this, is what are your limitations? Okay, is it time, for example? Is it knowledge or expertise? Is it relationships with agents? Is it an understanding of the whole property buying process? What are your constraints and limitations? All right. We recently had a client sign up with our buyer's agent services, and they said they thought they could buy an investment property on their own, and they spent the last 8 months searching and looking, and all they've ended up with is a headache, confusion, and missed opportunity. All right, because they started to realize that there are so many markets around the country, and how do you find the right areas on your own, and especially if you're a time poor person. Okay, so they realized that if they got clear on this up front, they could have got into the market so much earlier, all right, and avoided the stress and the headaches and the missed opportunity that it's cost them. All right, so get clear on your constraints. Once you're then clear on that, and this is something I really don't see too many others are talking about, is what's your risk profile, your appetite for risk, okay? Are you someone who's very conservative, you're low risk, so you just want to buy a property in a good location and see it rise in value, okay? Or are you someone who's a bit more aggressive, you have a higher risk appetite and you're looking to do more active strategies? So definitely get clear on you first and foremost. You are the most important part of your property investing journey. Step 2, which is what is the right strategy for you? Okay, now when it comes to strategy, there are a few things that you need to consider. As I said earlier on, if you're time poor, if you don't want to get involved in more active work because you're busy enough as it is, you're probably going to look for a more passive strategy. Okay, but sure, when you're looking at a passive strategy though, there are some other things to consider. Number one, let's say you have a borrowing capacity of, for example, $1 million. Well, should you buy one property for $1 million? Or should you buy 2 properties for $500,000? First question. Second question, should you be focusing on capital growth or should you focus on cash flow? Now, to help you answer those questions, let's have a look at a scenario where you may be, say, looking at a property for $500,000. Okay, so $500,000 price, okay, 500K. Now, let's say you're going to use a 10% deposit. You're happy to pay loan, mortgage, insurance, etc. Okay. So your deposit, D plus C, deposit plus costs, is going to be about $65,000. Okay. Now, if you're going to buy a property for say $500,000, okay, the question is, well, should you focus on buying a property that's really strong in capital growth or really strong in cash flow? Okay, now the positive cash flow guys are going to tell you, go cash flow all the time. Don't worry about capital growth. It's cash flow you need. That's what's going to give you passive income, etc. Okay, then you've got your capital growth guys who will tell you, no. Don't worry about positive cash flow. It's all about capital growth. It's all about buying a property in a good blue chip location, having it rise in value and making a good chunk of change. Okay, now which way do you go? All right, well, let me hopefully share some insights that will help you decide what's right for you. Okay, again, nothing I'm sharing here is advice. This is general information. You need to consider your own personal goals and constraints, and that's why I said step 1 in your investing journey when you're trying to build a property portfolio is to get clear on you on those few things that I went through. Okay, so here we go. You're buying a property for $500,000. You're putting in $65,000. Okay, now let's say this property, okay, is a really good quality property, and let's say it is positive cash flow by $1,000 a month. All right, now that's some pretty good cash flow, right? So I'm talking that's not the rental return. I'm talking about the after all expenses, interest rates, and everything else, you're earning $1,000 a month. Now, of course, it's a hypothetical scenario, but it's $1,000 a month. Okay, now is that a good deal? Well, the cash flow guys will say, yes, it is, absolutely, okay? But here's the thing. What if you have focused so heavily on cash flow that you've ended up buying in a location which has very little, if any, capital growth potential, okay? And yes, of course, now, at the moment, many regional locations are really strong and doing very, very well. But there are some regional locations where you're getting really strong cash flow, but prices haven't moved for years. Okay, so what if you decide to target one of those areas because you want the cash flow? Okay, the question then is, well, what's your goal? Okay, maybe you want to say get $5,000 a month in positive cash flow. Okay, so that means that you're going to have, based on this, you need 5 lots of these properties, right? Okay, because if each one is giving you $1,000 a month and you want a positive cash flow, passive income of $5,000, well, you need 5 lots of these. Okay, now yes, rents are going to rise, okay, but either way, you're going to need a few more of these. Okay, let's say maybe you don't need 5 of these, maybe you need 4, okay, of these properties. Okay, great. The question is, if this property isn't rising in value, how are you going to keep coming up with the $65,000 that you need? Okay, most people are not in a position where they can keep saving $65,000 to then buy a property. Okay, number one. Now, of course, you might say, yeah, but I've got lots of equity. Well, in that situation, maybe this might be what you want to do. Okay, but again, what I would say is that you really want to consider whether this is right for you, because what if there is a change in that location or those similar locations? There's an economic change, whatever happens to be the case, and all of a sudden you're not getting that kind of cash flow. Okay, maybe this property isn't going to be rented all the time for whatever reason. Okay, when you're not getting capital growth, number one, you're in a scenario where, well, if this property things change for you, your situation change, etc., you can't really sell this, at least not without making a loss, okay? Because remember, when you buy a property, especially in this scenario that we're looking at, you've got loan mortgage insurance, you've got stamp duty, whatever your other purchase costs are, right? So generally speaking, you need a property to rise in value by about 5% before you can get your money back, okay? So in other words, I'm saying this property here would have to go from 500,000 to about 525, okay? So if you sell it at 525, you could then pay your agent's fees, and you could then get your money back from stamp duty, etc., okay? And if you buy a property that gives you virtually zero capital growth, well then how are you going to build this property portfolio? Okay, so that's the challenge when you compromise capital growth to go just for positive cash flow. Okay, but on the flip side, what if instead of, say, buying this kind of property, let's say that you instead go, okay, I'm not going to worry about cash flow. I'm just going to go for pure capital growth. Okay, I'm going to buy what so many people tell me online to buy a blue chip property. Let's say I pay $800,000. Okay, and I'm going to have it rise in value. Awesome. Let's say it rises in value. Say it goes up 50% in the next few years. It's now worth $1.2 million. Okay, awesome, right? It certainly is what many would consider to be a successful investment because it's risen in value. However, if this is so far negatively cash flowed, okay, as many of these so-called blue chip locations are, all right, you may say, I've got so much equity here, the bank's going to lend me. And the biggest error people make is they think that just because they have equity, the bank will lend them money to buy another investment property. Not true. They will look at your cash flow, they will look at your income and expenses, all of that. And if they think that your property portfolio is too far negative, that's it. They won't lend you any more money. And if the bank doesn't lend you any more money, that's curtains for you when you're looking to build a property portfolio. Okay, so therefore, what should you look at? If positive cash flow is going to mean you're going to run out of money or not be able to build a portfolio as fast as you want to, and focusing just on capital growth means that could also end up stunting your ability to build a property portfolio, what should you do? Okay, well, here's what I would recommend. Okay, number one, be clear on what cash flow profile you need to buy a property at when you're getting started. All right, so what do I mean by that? Well, when you're doing your numbers and you want to work out, well, what's affordable, you might say, okay, I can buy a property that's $300 negative per month. Or no, I need a property to be at least cash flow neutral, even $50 positive a month based on your current income and expenses, okay? Get clear on what you need to start. Okay, now I'm talking about this from a starting position, okay? Why? Because once you know what cash flow profile you need, okay, you can then go and target the locations where you can get properties that match that cash flow profile, okay? So if it's $300 negative or $100 positive or whatever the case happens to be, okay? But what you then focus on is once you've got the cash flow profile right, you focus on the capital growth drivers, okay? Because here's the thing. Again, if we look at a property here for, say, $500,000, okay? $500,000. And let's just say that for argument's sake, that says $500,000, okay, that the property is positive cash flow. Well, actually, no, let's go negative cash flow here to illustrate this even better. Let's say it's negative cash flow by $300 a month, which you think is affordable for you right now, okay? However, once you know this, your strategy then is to ensure that you're finding the location where you believe the prices are going to rise and rents are going to rise. So that this property that's negative $300 today, maybe in 18 months, maybe in 3 years, whatever you think the timeframes are based on your research, it can go from being negative $300 a month to maybe positive $200 a month. Because you bought an area where there's massive undersupply of rentals and rents are rising because demand is so much higher than supply, all right? Then if you've also found a location where prices are rising as well, so maybe this property then goes from 500K to say 750K, What have you just done? You found a property that's giving you capital growth. And although it may have started off slightly negative, it's now positive cash flow, giving you that passive income that you're after when you're looking to build a property portfolio, plus giving you equity here, which you can then use to go and buy property number 2. Okay? That's how you build a property portfolio, because the key thing is when it comes to investing in property, you need to understand that every property you buy has to be a stepping stone to the next one. Okay? And that can only happen if you're buying in a market where rents are rising and where you expect capital growth to happen as well. Okay? So people often say, well, you can't get positive cash flow and capital growth, right? Well, you can on a property, but not always at the start. And that's okay if it's affordable for you. On the flip side, if, for example, you need a property that's at least neutral or positive cash flow, fine, of say $50 a month, okay? You're not going to retire off that, okay? But the key thing is you found a property for say $500,000, but it's not impacting on your lifestyle right now. And if rents are rising and prices are rising, eventually maybe this becomes positive $300 per month and goes from $500,000 to $750,000. Okay? That's what you want to look at when you're trying to understand, well, am I going for capital growth or cash flow? Okay? It's not an either or. Neither is it as many people say, oh, you got to find the perfect location where you get both every single time. Okay? If you need that, yes, they are available, but you're going to have to compromise on something somewhere. Okay? But if you have the ability to go somewhat slightly negative or, essentially neutral cash flow, so it doesn't impact on your lifestyle now, then you're buying a property is going to give you that cash flow in the future. Hopefully you can see that nothing I'm sharing here is about get rich quick. Okay, this is about get rich safely according to a proven plan. Okay, and so once you understand the type of properties that you want to look for to build a property portfolio, then the question of, well, should I go for $1 million property or a $500,000 property doesn't really matter. What you want to do is focus on A-grade properties. Okay, don't think that, I'm going to get 2 cheapies and compromise on quality and get 2 B-grade properties. Focus on the quality of each purchase. Make sure it meets this criteria of got good capital growth drivers and rising rents, and then you're going to build your property portfolio faster. So then we look at step 3 is, well, where do you buy? Where do you find these kinds of properties? Okay, now I've spoken about what capital growth drivers you need to focus on in the past, so feel free to go through past episodes. But here's one thing I'll tell you. Focus on locations which have strong demand from owner-occupiers, or you expect will have strong demand from owner-occupiers, okay? Now, owner-occupiers, people who are going to move and live in that particular area, okay? Because as property investors, we don't create capital growth. Okay, what we do is we ride on the coattails of owner-occupiers who are buying in a location to live there. That is going to create demand, and especially if that demand is higher than supply, well, odds are prices are going to rise. But the second thing, when you focus on locations that have high demand from owner-occupiers, is that it means that the number of available properties to rent is rapidly shrinking. That means that when you go in as an investor to buy a property, odds are there's going to be significant demand from a rental perspective as well. Okay, so you're buying a property that's in high demand from owner-occupiers in a location that's in high demand from owner-occupiers, where there's an undersupply of properties to rent, where then you can get your property rented quickly and where rents are going to rise. Okay, and then the last 2 steps. Step 4, pay the right price. Now, this might seem very obvious, okay, but in order to pay the right price, there's 2 things you need to know. Number 1, once you've found the right locations, you need to understand what's market value, right? What is a 4-bedroom, 2-bathroom house? What's the market value of that kind of house in that particular market versus maybe a 3-bedroom house? What about land size? What about proximity to schools? Does that change market value at all? Okay, you need to really be clear on the market value so that you know what to pay, so that you don't overpay, and more importantly, you can then try and negotiate a deal. Okay, Do not think that what the agent is listing the property for, that's market value, okay? It could easily be below what the market is actually willing to pay because they're trying to get more buyers. Sometimes they might be listing it above market value to try and get maybe an interstate investor who's trying to do all their research on their own and will pay too much, okay? So be clear on market value. And here's another tip is that in the current market conditions, if you want to buy a property at market value, or if you can under market value to give yourself a head start. So for example, we recently bought a property for a client. Market value for this property based on similar sales right now was $740,000. We bought it for $699,000, okay? Because we understood the motivations about the vendor, we had good relationships with agents in the area, and so we were able to target the right property for our client, okay? So by doing that now, our client is 40 grand ahead, okay? So you want to see if you can get something under market value. And therefore, if that's your goal, you don't want to buy something that needs to be built, especially in 2022 and going into 2023, because with the current market conditions, construction costs have risen so much that if you're going to buy a property that needs to be built, you're going to have to pay a significant premium. Okay, so again, coming back to our example of $500,000 properties, if you're going to buy something where the market value is $500,000, but a brand new property might cost you $600,000, so yeah, 20% above market value, guess what? If you pay $600,000 and market value is $500,000, you've got to wait for the market to catch up to you and then go onwards before you're going to get any sort of capital growth. Okay, now, odds are though that if the market doesn't come up, you may have to sell the property at a loss or just hold on and hope and pray. But whatever happens, it's going to slow you down from building a property portfolio. Okay, so definitely right now, ensure that you're buying established properties. And then finally, step 5. This is where you want to track your portfolio ongoingly. Okay, because property investing is not an event, a one-off event where you find the best property in the best hotspot and then you're done. No, especially if you're trying to build a property portfolio fast, you need to track your portfolio, okay? So what I mean by that, again, is if you look at a property for, say, $500,000, price equals $500,000, okay? You want to track to see, well, okay, in 12 months' time or 2 years' time, whatever the case is, has it risen in value? Okay, so maybe is it now worth, say, $650,000? Great, okay? Now, and have rents have risen. So then you can go back to the bank and check your borrowing capacity and see if you can tap into a good chunk of this to go and buy investment property number 2. Okay, but you need to be tracking your portfolio at least on an annual basis, and that's what we do with our clients, okay? So that you're not missing out on opportunities, so you can build your property portfolio fast. All right. For example, one of our clients, we bought them a property number 1, they paid around about $435,000. Okay. 18 months later, when we got it revalued by the bank valued it at $610,000. Okay. A significant uplift in equity. Rents had risen like 50 or 60 bucks as well. Okay. So with the increase in equity plus the increase in rents, they had the borrowing capacity to then go and buy property number 2. And now they've got 2 properties in the market and we're going to keep tracking them. And when they're ready to go again, we're going to use the equity in those 2 properties to buy number 3. All right. So there you go. The 5 steps you need to follow if you're a property investing beginner, you're just starting out and you want to build a property portfolio fast. Hi, it's Nero here again, and thanks so much for watching. If you like what you saw and you're looking for a proven recipe, a blueprint on how to build a property portfolio that gives you passive income, then click the link below this video and get a copy of my book, Wake Up Wealthier, How to Build a Property Portfolio that pays you an income each and every month. Okay, when you click the link and you download your book, you can get both the digital version and the audio version in case you don't like reading. All right, so I used to sell this book for $49, but right now I'm making it totally free. Why? Because I want more people to get this information, and I know that a segment of you will then like what you see in the book and choose to reach out to find out more about our services. But even if you don't, If you're serious about building a property portfolio that pays your passive income, then you really want to get my book, Wake Up Wealthier. It contains the secrets that I have fine-tuned over the last 19 years. It's totally free for a limited time. Click the link below.